The stock market will remain irrational longer than you can remain solvent, and I can't quote how many people I've come by that are absolutely getting obliterated this year in one of the greatest stock market rallies we have ever experienced in any given year. And I wanted to help you guys out, coming from somebody that has consistently outperformed the market for 7 years, rapidly doing like 35-40% gains a year, only comparable to the likes of Warren Buffett, Ray Dalio. I'm gonna toot my own horn like there's no tomorrow, because this may not last into tomorrow. So while it does, I'm going to help you out a little bit, okay? And I know, guys, if you are an individual stock picker, it is an incredibly large challenge, because the reality of being an individual stock picker is you are up against one thing and one thing only, and that is index funds. Because honestly, if you are trying to pick individual stocks, you are taking on more risk than the average investor, meaning that you should get higher rates of return than the market average. And this is bar none the hardest market to outperform. Take a look at the S&P 500. It is up 26.83%. By the way, these are the safest of all the safest investments you'll ever make in your life. The Vanguard Total Stock Market Index Fund here, guys, up 24.98%. And dare I say, the mythical QQQ ETF up a whopping 28.9%. Dare I pull up the TQQQ ETF and remind you of how stupid your investing has probably been when you could have just parked your money in 3 or 4 of these beautiful ETFs, been perfectly diversified, and outperformed some of the greatest investors and stock pickers that exist. So why am I showing you this? Because I want to tell you, if you're buying individual stocks, what you need to be looking for and why you're failing miserably, even if you think you can run great valuations. And it comes down to something that almost seems stupid to say, but it remains true more than it does not. And that is, winners remain winners and losers remain losers. And I can't figure out why every YouTuber under the sun right now continues to talk about and analyze the hell out of their losing positions. I can name tons. I'm sure you can. We're going to look at some of those losers today. But let's first and foremost talk about the winners, the stocks nobody talks about anymore and have remained winners for just a stupid amount of time. Apple. You know, since I bought Apple, like, I don't even know, 5, 6, 7 years ago, that every single year I hear the same shit about this company, yet it keeps remaining the largest company in the world than it was when I bought it. It is up 516% year to date. If you picked this winning stock consistently year over year, you have outperformed the broader market. Google, common sense investing here, not doing nearly as well as, let's say, Apple, but winners remain winners. And yes, some of these are overvalued. Will these continue to be winners into the future? I do not know, but for as long as they are winners, they seem to continue to be. Amazon, great example, 358%. Nobody talking about Amazon these days. Let's be real. These are like really shunned stocks. People just don't, everyone has an opinion around these top 3 companies, yet I doubt your portfolio comes close to the comparison of growth here. Even Tesla, for Christ's sakes. Tesla, overvalued junk by everybody on Wall Street from the day I started buying it in 2019. And you know what? I'm glad I bought my shares back, because the reality is the winners remain winners. Overvalued or not. Hell, Bitcoin. You all hate Bitcoin. I know a lot of you in our chat group shit on this, a lot of boomers out there. Yet, in 5 years, holy crap, 6,000% gains. And look, Bitcoin hit an all-time high not even a month ago, guys, because winners remain winners. So let's talk about some losers here, because one of my favorite losers that I sold, Altria Group. Altria Group, I could beat my head against the wall like a dead horse here when it comes to people that will try and justify to me why MO is a great investment. Ooh, it pays an 8% yield. But the fact of the matter is if you bought this loser 5 years ago when it started becoming a loser, you weren't getting an 8% yield. You were probably getting much less than that. And now you're down 32%. And God knows that dividend did not make up for the amount that you're down. Now, you can believe in this all you want. You could tell me any way to justify your stupid investment decision here. And I'm not trying to tell you why it's a good or bad investment from a value standpoint here. I'm just telling you, in 2017, this thing became a loser and it remains a loser. And I will probably make the bet that it continues to be a loser in the coming years, because it has been in the past, and the past is the only thing we can represent into the future. Alibaba, this is kind of becoming a new loser, but this is an example that I want to put out there because I talk about it a lot. A lot of people highly fixated on this company right now. And it recently became a loser, and it continues to be a loser. And I'll make the bet that for the time being, it will likely continue to be a loser. Does that mean you should not be buying this company? Absolutely not. And I'm going to explain more about picking losers in a second. But I mean, let's talk about SPACs. I could talk about an endless amount of SPACs. Hyliion, Nikola, I mean, Virgin Galactic, all of these companies that just kind of came into the market, got extremely overhyped, and then immediately became losers and continue to be losers. And I don't know what it is, but people beating a dead horse about these SPACs when they should be focusing and moving on from, percentage investment allocation, which I'm going to talk more about in a sec. I mean, I can name tons of these. Like, look at Wish. Wish was another big one of these Wall Street meme stocks that became a loser and is down 83% and just cannot capture any life. And I mean, like I said, I could show you dozens and dozens and dozens of these, and there's a good chance you have one of these in your portfolio, and you are probably fixating on it far too much. And let me explain to you what I mean by fixating on this. Taking a look at my broader diversification here in my over 300, and today I valued it up. I mean, I'm sitting on well over 360K. My portfolio is a few points out, if not at all-time highs this week again, and I can only attribute being at all-time highs to one thing. I pick winners and I allocate my losers correctly. I really like BABA here, folks, but I can't figure out why people keep shoveling money into their losers. Like, for some reason, the stock should just turn around, even if they post good news. I know so many small cap companies right now I could hand off to you that have incredible numbers, that have insanely bright futures, yet are still massively down against the market averages this year. Yet, for some reason, even though I can name a ton of companies in my portfolio that are overvalued, guess what? I am green on every single one of these except for one. And look at the vast majority of stocks that make up half my portfolio. VOO, index fund, Apple, Microsoft, Facebook, Google, Tesla. I mean, Tesla's become the largest position. Why? Because it's a winner, not because I allocated it that way. I mean, Johnson & Johnson. I mean, you're talking about Pepsi here. All of these companies continue to be winners. Even though some are overvalued, I will still make the bet today they continue to be winners. So when we are buying value plays, because, I mean, Warren Buffett, we're all taught value plays, look for those stocks that have been beaten up because they are likely going to give you the best return going into the future. And that, though may be true, isn't always true, because the market still has to conceptualize why they should be buying it, even if the numbers are incredible. Alibaba, prime example. So how do we go about doing this so we do not hinder the performance of our portfolio year over year and drastically underperform the market? Simple. It is called allocating assets correctly. When we get emotional about companies, like I'm watching Financial Education, constantly talking about what is Corsair Gaming, constantly talking about Tattooed Chef, who the hell cares at this point? You're beating a dead horse, man. Just put your asset allocation, no more 3, 5, 6, 8%, whatever your comfort risk tolerance level is, set it up there and forget it. If it drops, hey, maybe buy a little bit of the dip, but don't keep throwing money into a burning fire. That is a surefire way to underperform the market. Anybody that has been buying Alibaba for the last 6 months 100% understands this. This is why I have no problem selling stocks for losses. I sold some of my mom's Alibaba position down, even though she's the only one that I currently hold the position for right now. And I think it's a good example of, I thought she was overexposed to a position that was likely becoming a loser. I still hold those shares for my parents, but at the same time, I recognize positioning that into the VOO. I bought some Facebook with that. Stocks that have drastically performed a lot differently in the same time period because those were winners. You have to understand this, guys. People get too emotional about stock market investing. This isn't an emotional game. It is a risk tolerance, asset allocation, risk game. That's all it is, guys. You don't like Bitcoin? I don't care. It's a winner. I'm going to buy it. I'm not going to load the boat. I mean, it makes up 3% of my whole portfolio right now, but that 3% has been doing very well since I've been cost averaging into it. But I'm not going to let those things get out of control, right? Just like Tesla, if Tesla gets out of control, even though it's been a great winner, and at any time these stocks can become losers, I recognize that for my risk tolerance, just because a winner sustains being a winner doesn't mean you shouldn't take profits on it either. But like I said, this just seems like a stupid, refined way of looking at things, but I can't figure out why. Literally everybody in the market right now is just talking about these beaten down stocks, yet I don't hear one person preaching how, Apple's hitting all-time highs and like nobody wants to buy Apple here. And again, I get it. They're overvalued, but for some reason, guys, they just keep going up and the losers keep going down. This will eventually shift. Sure. Allocate respectfully and try and outperform the market here, guys. I know it's really hard in a one given year to try and, base off any kind of performance. Usually you need a good 3 to 5 years to base performance of your portfolio against the S&P 500. But God, does it ever hurt if your portfolio is down, let's say 10% this year, and the S&P is almost up 30%. That means you have, a 40% difference against the market average return that now you have to make up for at some time in the future to even get back at par with where you should be. Common sense here, guys. I'm sorry, it is blunt. And if you want to see if I can continue to beat the markets, because man, oh man, I just looked at my performance and it's nuts. I mean, I got my November performance, can't wait for the December performance, absolutely absurd. And I don't feel like a genius. I don't know why this keeps happening to me, but I think I can refine it down to just being able to understand where market attention goes, what makes a good company. And sometimes it's not always fundamental based, even though I try and make fundamental investments because I do like BABA and I really want to buy it, but I'm patient because, like I said, I kind of recognize it like MO. Even though MO has great fundamentals, doesn't mean the stock is going to go up. In light of this, folks, I'm going to pass the question off to you. How have you been finding your portfolio this year? I'd love to hear what you think about this weird, simplified version of investing. This is entertainment, by the way. I'm not a financial advisor. I'm some kid that lives in his parents' basement. So stay cool, stay awesome, and I look forward to catching you tomorrow.